We're talking about some of that trend data that we're getting from JP Morgan. It really points to people looking for yield and also trying to protect portfolios. When you talk to your clients, what are you advising when it comes specifically to the bond portion of their portfolios?
Yeah, I think one thing we're advising is right now is a good time to be in short-term treasuries, in money market funds that are high yielding, and a lot of them, have that same notion. If you're hearing over the last, 5 to 6 months, what you can get in a high yield savings account, if you're seeing the cash shorting that's going on, a lot of people are very much inquiring about that, and I think that's a good strategy right now. If you look at, what the S&P 500 and what the Nasdaq is pretty much, quiet as kept, pretty much virtually in bull market territory right now, that doesn't lend to a lot of short-term, bullishness in what's going on. And I think a lot of people are looking for protection. And right now, short-term, shorter-term duration bonds and treasuries are a great place for people to find that protection, as well as just have, a dividend stream and an income stream that's, quite usable for people in a situation right now where inflation is still running rampant. So people are looking for that protection. I think it's a good place for people to look.
So you said the Nasdaq 100, also the triple Qs, a way to invest in them. Quiet as kept is one of the in bullish and bull market territory. It seems like that's a trade that a lot of people are actually piling into, mega cap tech. Are there certain parts of that trade in the triple Qs that you think people aren't identifying as well?
I think that trade is still in a good trade for people, but from my standpoint, and last time we talked, I was thinking that around May, things would get a little bit skittish, and I think we're getting close in that territory where folks would want to maybe shift out of a little bit, for the fresh cash, shift out of those trades and look at new cash going into, as I mentioned, like those short-term treasuries as well as value plays. Because right now, if you look at the near term, there are things bubbling under the surface that might lend to a little bit more volatility. If you look at the credit crunch that we could potentially have, that's a real risk right now for investors. Yeah. And I think that slows down a little bit of what's going on in the economy. Banks are going to have higher credit standards. Obviously, could keep liquidity on hand, and because of what's going on with consumers. So I think that trade is going to come back in the longer term. But in the short term, that trade is a little bit more of something that I would be cautious of.
All right. So worried about the credit crunch. What about the U.S. debt ceiling? We talked about short-term treasuries just to protect portfolios, but what's your take on that? Do you believe there is going to be a default? Are you worried about the credit rating of the U.S.?
So I don't believe there will be a default. I understand that there's a smaller risk there, and I think if you look at the reasons why, understandably there is a risk, is last time we were downgraded by the S&P in 2011, the interest on debt was $425 billion, and if you look at where we're seeing now, it's around $930 billion, and so that's a real risk. And obviously, as a percent of GDP, the debt for the U.S. is obviously 95%, which is a huge amount. So those are real reasons why there could be some sort of downgrade. But I think if you look at what Standard & Poor's is saying and the outlook, the big reason why I think it's still stable is because there is more than likely going to be something happen in legislation that will raise the debt ceiling, and we will be in a good position, right?